All right, it is 1:30, so we're going to go ahead and get started. Good afternoon. Welcome to today's webinar, How You Can Use Software to Make Roth Conversions Easier. My name is Lauren LaFrilla, and I'm the Director of Communications here at Covism. I'm joined today by our speaker, Joe Alsasser. Joe is a certified financial planner and the founder and president of Covism. Under his leadership, Covism has developed a variety of groundbreaking tools, including Social Security timing, which was the first patented Social Security optimizer, tax clarity, smart risk, and income insight. Joe co-authored Social Security Essentials, Smart Ways to Boost Your Retirement Income, and is a regular contributor for USA Today, Investment News, Retirement Daily, CNBC, and Think Advisor. Joe also maintains a financial planning practice in Omaha, Nebraska, doing the very things he'll talk about today. As I mentioned, our topic is how you can use software to make Roth conversions easier. You should see a button labeled Q&A. If you have a question, please type it in the box and we'll address questions at the end of the presentation. And just a reminder that we will be recording today's presentation and you will receive a link to the recording in your inbox later today. Thank you so much for attending, and I'll turn it over to Joe.
Thanks for the intro, Lauren. Always fun to do these. It's exciting that other people care. It's one of those things where it's really a rare financial advisor among the huge population of advisors out there that's willing to take the time to dig in to say, how can I do this thing that doesn't directly sell anything? Instead, it's just there to improve my clients' lives. Advisors like you are the kinds of advisors that if I'm a consumer, you're exactly who I want to work with. You're thinking about the things that matter to me. So really what I'm excited for today is a lot of like-minded individuals. And I hope at the end, there's a lot of questions based on your experiences, things you've done in your own practice, things that maybe are taking a lot of time. And maybe you see a path here that is a little less time consuming than the way you've gone about these in the past. So we're going to talk about how to make Roth conversions easier using software. By way of background, Lauren kind of mentioned this, but we started out as Social Security timing. So that may be how you know us. But today, our focus is really going to be living in two of our other products. It's Tax Clarity and Income Insight. They both provide a little bit different lens into how we do Roth conversions, how we practically do them for clients, really on an ongoing basis. So here's the agenda. First off, why bother? If you're here in the first place, you probably have a good idea why Roth conversions can be a really valuable technique for your clients. Second, we're going to talk about how to consider options for lifetime strategies. Really, when we're sitting with clients, oftentimes our job is not just to talk about this individual thing that we're going to do this year. Instead, we want to talk about broad strategies that we can apply over a lifetime. And the tactics that we're going to use inside those strategies are going to vary a little bit from year to year. But really, it's a way of looking at a lifetime retirement income plan and then tactically implementing it year over year throughout a retirement. Third, we're going to dig into a key concept in how we do this Roth conversion planning. And that concept is the effective marginal rate. And that's so important as we get down to your service calendar. When do you implement Roth conversions throughout the course of the year? And why do we do them when we do them? We're going to close out with how do we drill down to get this year right, and how do you market these services? You probably can't see this, but there's 69 slides today that we're going to cover in about half an hour. So I'm hoping there are a good number of questions as well. And if I draw it out to 40 minutes, I'll just ask for your patience, and I'll apologize in advance. I get a little nerdy on this stuff every once in a while. So that's the agenda. Lauren, I think we've got a poll to kick off to start this off, right? Are you currently doing Roth conversions regularly for your clients? And we'll give that just a couple of seconds to field. It should pop up on your screen. Just pop your answer. We'll give that a little bit to update, and then we'll dig into the rest of the presentation. Outstanding. So we've got some people, a little less than 20%, that are frequently doing Roth conversions. We've got about half that are occasionally doing Roth conversions, and then a few on the other end of the spectrum. Outstanding. That gives me a good idea of a little bit more where we'll focus today. So we start out in the big picture. Why bother with Roth conversions? These are three core metrics that Income Insight that we use and how we think about retirement income planning. So if we really think about what most people do, what most naive people who have not studied any kind of harvesting patterns, and they do what most, and even most accountants are still recommending this harvesting pattern. But what most people do is they claim Social Security as early as possible. It's changed a little bit over the years, but still the majority claim early. Then they use non-qualified money or taxable accounts for as long as possible, supplementing that Social Security. Then they get into their IRA money, either because their non-qualified money ran out or because they hit required minimum distributions and they're forced to begin taking money out of the IRAs. And finally, they use Roth money if they have Roth money and if they need to. So that's everything we do is a comparison against that base case. And we measure any of these plans by three core metrics. The first of those core metrics is portfolio longevity. How long does the money last? So in this case, you see we've got a need of 34 years, and in the base case, we meet it for 34 years. The second question is, if we run out of portfolio assets, what percentage of our ongoing retirement income need continues to be met by guaranteed income sources like pensions, annuities, et cetera? So in this case, the income floor, because the portfolio does not run out, they're able to meet that entire income need throughout their lifetime. The estate value is what is left over, and this is the present value net of taxes of what is left over to the people or causes you care about. So this is a plan that only includes a Roth conversion, and it represents a roughly $100,000 increase in the present value of the eventual estate. In other words, doing a Roth conversion for this particular client case is worth 100 grand in their portfolio today. That's why smart advisors are bothering with Roth conversions. And those numbers can be considerably larger. This is a pretty typical case, and we're going to dive into this case a lot deeper throughout the presentation. Now, this is a fantastic paper that just came out 2 months ago. I would have probably broken it down a lot more. I just found the thing a couple of weeks ago. So if you're really interested in this topic, I would definitely suggest pulling this Edward McQuarrie paper. He's from UC Santa Clara. Actually, he's a professor emeritus. But he really did an extensive study on the multiple situations where Roth conversions are beneficial and some situations where they're maybe less beneficial. This was one of the loudest conclusions he came to, is when you have a big tax deferred account, and so you're going to face tax brackets of 20 plus when required minimum distributions begin, and when you can arrange a year when you've got a blank tax return, when you've got really nothing else going on, you should absolutely take the opportunity to convert. And how much to convert, that's what's complicated, because that all depends on how much of a surplus the retiree expects to have and how profitable they want the conversion to be. The good news is those are the things that we're going to address in today's webinar specifically. It's that complicated question of how much should I convert? What conversion patterns should I follow throughout retirement? So there are a variety of potential benefits to Roth conversions. And all of these benefits really end up translating into the value that we mentioned on that first slide. We might be taking advantage of low tax bracket years. Maybe we've got some room left in a 0, a 10, or a 12% bracket. We want to be filling those for most clients anytime we can. Maybe we're reducing an eventual RMD that is going to push our income way up in future years. That kind of situation often results in increased Medicare premiums with the income-related monthly adjustment amount. It might help us reduce net investment income tax down the road. It might help us reduce future taxable Social Security, and it definitely creates tax flexibility where we have some assets that we know we can go grab in the event we have a large expense or we die in an inopportune year, maybe when our beneficiary is still in their peak earnings years. And so having to distribute traditional IRA assets would be very tax inefficient for our beneficiary in those years. Another tax flexibility situation might be future years where there are uneven tax changes that really negatively impact traditional IRAs, but don't really have an impact on Roth. So there are a variety of potential benefits that are out there. What we'd like to do is just focus on those three core metrics, but these are talking points when you have clients who say, well, what are the reasons we might do that? So that brings us to a second poll question. The poll question is, do you use financial planning software currently? And what we're really looking for here is how systematic are your structures, right? Because sometimes we're going to be implementing these in really systematic ways. That's what we do in our practice. It's really what I'm going to try to focus on today. All right, looks like we've got some results split pretty evenly between yes and sometimes. So just by way of background, we do use planning software with every single client 100% of the time. We actually, in our practice, we don't take investment only clients. I know that's weird, but if somebody comes to our office and says, hey, here's $100,000, here's $500,000, here's $1 million, invest it for me. If we don't do a financial plan, we don't do the investments. That's how we work in our office. And so in every client case, we're looking for these kinds of opportunities, primarily because these kinds of opportunities are the number one way we get referrals. And I think that's a really valuable thing to remember is a process like this is a highly referable process. So I mentioned at the beginning, we were going to dive into some of the details that produced that $100,000 additional value. So here's our case study. We've got John and Jane. John's born in 1957. He's a higher wage earner, not quite at the very top, high wage earner. And she was a middling wage earner. Maybe she had some years out of the workforce. She was born about 3 years later. They both happen to be born on tax day. So we're planning for 90 for him and 95 for her. As far as investments go, he's got $1.5 million in his IRA. She's got $500,000 in hers. And jointly owned, they have a taxable account that's $500,000 with a current basis of $300,000. And all assets are invested in a 60-40 stock bond portfolio. I'm going to put a caveat here because in no situation would we have that happening post-plan. The reason we do that for a case study, have all assets invested in a 60-40 stock bond portfolio, is so that we don't get any, we'll say, visibly positive effects from investing the Roth more aggressively than we would have invested the IRA. If we're going to invest more aggressively, then theoretically that carries risk. And if that carries risk, then the result isn't on par with the result for our base case. And so that's why we're going to just maintain the investment allocation. In reality, we would reallocate the Roth assets that are very long-term assets to something more aggressive, which often does provide some additional value over time. So when I bring that into Income Insight is the primary tool of our stack that you would use in order to illustrate the lifetime value of Roth conversions. So we can see John's got 1.5, Jane's got 500,000, they've got 500K of non-qualified. What I want to draw your attention to is we've got $8,000 of basic income needs every month. We actually have a survivor income need also here that is $7,000, and then an additional $1,000 a month of fund money. So while both are alive, it's $9,000, and then it drops by $1,000 after the first death. And you see the Social Security benefit amounts. You also see some assumptions here. So the inflation rate inflates both tax brackets and any inflation adjusted income streams, and it inflates expenses. And then you also see the discount rate, which is what we use to bring back to today's value, the future value items, such as the estate value at death. We've got a beneficiary tax rate of 25% for this case study. And so to run the base case, we just click on the Income Insight tab, and from there, we're going to get to a base case results. So what you'll see is a portfolio longevity. You've got a client situation that's in really good shape here. They've got a portfolio that needs to last 34 years. It lasts 34 years. We need $96,000 a month for the income need to be met. They're meeting 100% of that. And we've got an estate value left over after people and causes they care about and net of taxes of 1.265. These stress tests, we're not going to pay any attention to during this webinar, but if you're doing any real planning for clients, you're going to use those as well, because the idea is, does our strategy survive a down market? Does it survive the risk events in a client's life? So this client is in pretty good shape. What we're really looking for here are opportunities to improve what's left over for the people or causes they care about without sacrificing any lifestyle today. And so what we need to do next is go to the Plan tab. And If we click on the plan tab, it's going to expand, and it starts out with no strategies included in the plan. What we'll choose is the harvesting pattern. So built into Income Insight are a variety of different harvesting patterns. And here are the standards. So we could harvest IRAs first. We could do a Roth conversion to a variety of different effective marginal rates. You might have think of this as filling a bracket. So initially here, we're going to choose Roth conversions to a 12% effective marginal rate. And I'm going to come back to this concept of effective marginal rate later if it's not something you've heard before. So we just created a plan, and the software automatically filled those brackets throughout the course of those years. And now we can judge and we can say, does this plan work out better for the client than the base case? So we use those objective metrics. We say, yep, the portfolio still lasts. Yep, we still meet 100% of the income need. Only now, rather than leaving 1.265, we leave 1.432 to the beneficiary. Pretty exciting stuff, and a lot of quantifiable value to add to the client just by virtue of changing which account we're going to draw from at which points in retirement and how we do those Roth conversions. So you notice over here what's included in plan. We've got a Social Security strategy in there. I'm going to come back to why we do that later, but for now we have the option to exclude or remove the Social Security strategy. So I'm going to do that. Income Insight automatically includes the Social Security strategy whenever it changes the harvesting pattern. But for now, I'm going to remove it so that we can see what the impact is solely of the Roth conversion. And what you'll notice is once it's excluded, our estate value goes from 1.265 to 1.326. Still a dramatic improvement, but not quite as much as it was when we included the Social Security strategy as well. So let's try a different harvesting pattern. You notice there were a variety of different harvesting patterns available. This next one is probably my favorite, and as far as I know, we're the only software out there in the marketplace that does this. This is called a Roth conversion to the average effective lifetime rate. So here's the concept. If we were to look at the base case, and we were to take the average of all of the tax rates throughout the years of retirement and say, okay, maybe that's 14% is their average effective tax rate. I only want to do Roth conversions up to that point. I don't want to pay more than that in any given year. So you could also think of it as a first do no harm Roth conversion, right? Where I'm never going to pay more taxes under the plan or more taxes in a single year under the plan than I would have paid under my base case. So that's the concept of the Roth conversion to the lifetime effective rate. And what you'll notice when we do that, we go from 1.264 up to 1.360. So that's actually an improvement over just converting to the 12% bracket. Now let's try another one. Let's say Roth conversion to a 22% effective marginal rate. Oops, we actually went backwards with that. There's no additional value in following that conversion pattern. So it took me about 5 minutes maybe total to identify several different lifetime patterns, test them against each other, and have a quantifiable value difference, a reason why I chose the specific amounts that I chose over the course of the client's lifetime. Now we actually have the ability to compare the base case versus the plan. So I might click the compare button. And we'll see over on the left-hand side, there will be a column of charts that are the base case. And on the right-hand side, there's a column of charts that are the plan case. So this plan is Roth conversion to lifetime effective rate. And so what you'll see on the left, we've got no orange. On the right, we've got orange. The orange is the difference in the Roth account. So on the right-hand side, you see a substantial portion of the client's assets have actually been converted to Roth by the end of their lifetime. It represents, it's the largest single account by the end of their lifetime. So there's a key concept here that underlies each of the harvesting patterns that we just talked about. It's the concept of the effective marginal rate. In other words, how much do I actually lose on the next dollar? And tax clarity is how we identify that. So everything we just did was in Income Insight. This is an illustration that you see in tax clarity. And it's this idea of, as I move to the right across the bottom, I'm adding ordinary income. So in other words, I'm increasing my IRA withdrawals. That's the most common lever. It might be a variety of other things, but that's the most common lever we're pulling in retirement. And what I'll notice is that even though my red, which represents traditional thinking about tax brackets, so this is a 10% tax bracket, doesn't start till over $26,000, pushing $27,000 because of the standard deduction. In reality, because I've got some Social Security on the tax return, once I get to about $11,000 of IRA withdrawals, I start experiencing an 18.6% effective marginal rate, then a 22.2, then a 49.95. This is the kind of thing that surprises a lot of people. And you might say, how on earth could a 49.95% effective marginal rate happen? What intuitively we would expect to happen. If you look at this map, you trace this 49.95 down, it's falling in the 12% tax bracket. And if you look at any of the major tax prep softwares, it's going to tell this person that's in this range that their tax bracket is 12%. But what's actually happening on that slice of income is a $1,000 IRA withdrawal does in fact get taxed at 12%. But then it causes an additional $850 of taxable Social Security, which creates an additional $102 of tax. Then it causes $1,850 of capital gains to be pushed out of a 0% bracket and into a 15% bracket, creating an extra $277 of taxable income or of tax. So on this extra $1,000 withdrawal, the client actually lost $499.50 to tax. Now, when we think about these harvesting patterns, what we're really doing is we're thinking about retirement as a series of 30 or 34, in this case, of these tax maps. And if you think about that, what you're really looking at, if you stack those all up front to back, you'd be looking at what might look like a mountain range from the top. If you think about how you'd want to cross a mountain range, it certainly wouldn't be from peak to peak to peak to peak, right? You'd be wanting to walk through the valleys. Now, that is effectively what we do, what we automate through Income Insight. So here's a tax map comparison. On the left-hand side, you've got the base case. And on the right-hand side, this is like clicking the compare button. On the right-hand side, you've got the plan case. So in our base case, the client recognizes just under $10,000 of ordinary income. They pay zero federal income tax. They're thrilled. They have no idea that they missed a huge opportunity. On the right-hand side, we said, let's do some Roth conversions. Let's take it all the way up to the edge of the 12% bracket. And so rather than wasting this 0% bracket and wasting the 10 and 12 here, we're actually taking it out right to the edge of the 12. And actually, it's before you hit 27 because we've got some capital gains that become taxable at this point right here. So it's really interesting, this idea of walking through the valleys and filling up those places where the tax map would give you an artificially low opportunity to convert assets to Roth. You look at the next year. So this is 2022, very tax inefficient in the base case, pretty highly tax efficient in the plan case. We've got a little Social Security that kicked in here. So that's why we stopped at that point. We also maybe could have gone out to here if we wanted to. And the next year, same concept. We're filling up that low part of the bracket. So Income Insight basically automates, it programmatically creates a lifetime Roth conversion schedule for you. And it's there. The reason you would do that is to demonstrate the lifetime value of following a harvesting pattern. That's like giving the client a strategy that they can stick in their head and say, in general, I'm going to convert some every year that it makes sense. Now, some years I might not do a conversion because in those years, something else happened and it didn't make sense. But whenever I can, I'm going to look for that. Why? Because I know that it's likely to pay off over time. And that's what my lifetime value metrics show me. Now, I mentioned earlier that I'd come back to why do we pair with a Social Security strategy? And the reason is because when we implement a Social Security strategy, we end up getting a much greater number of years of income flexibility. In almost every analytical evaluation of Social Security in retirement income plans, you're going to end up with at least one member of a household delaying benefits, which just allows us to do larger conversions for a different amount of time. So we often see larger conversions at a 0% bracket by implementing a Social Security strategy. It adds value both because of the Social Security strategy and also combined value because it opens up greater opportunities for conversions. It's automatically included, as I demonstrated, when you select a harvesting pattern, and you don't have to pay extra for that functionality. If you don't want to deep dive into the Social Security decision, you just want it included in the plan, you get that functionality without having to subscribe to Social Security timing. So that's just included in an Income Insight subscription. So when we include, all we got to do, remember in our case, we excluded it. So all we have to do is click that include button to get it back into the plan. And we see the value, the estate value jump from 1.265 to 1.465, $200,000 of present value. That's like 200K added to the client's accounts today. So notice the difference in harvesting as well. Over here on the right-hand side is the income by source chart. In our base case, we were going non-qualified money first, but without changing how we did Social Security. We were taking Social Security early. So you saw them all stacked on each other. Now you've got them a little more sequentially. We've got all the non-qualified money being used in the first 4 years before we get into IRA money. And then we get into the Social Security dollars a little later. That's the pattern here. And look at the significantly higher Roth balance. In this case, the Roth assets, totally tax-free assets, end up being worth, roughly, I believe that's about 50% of the final value. So when we implement a Social Security strategy, we also get a different conversion pattern. And the reason is we've freed up that bracket, right? Now we all of a sudden don't have anything getting in the way of doing some larger Roth conversions early in retirement. So that's actually what we saw in this particular case. That's why we ended up with a much larger ending estate value and a much larger Roth balance. So we get down to how to do this practically. We have some real considerations about your service calendar, right? This is not work you want to do in January anymore. Prior to 2017, prior to the Tax Cuts and Jobs Act, we wanted to do all our Roth conversions in January and February because we knew we could come back the next year and recharacterize, undo parts of that Roth conversion. Now we can't do that anymore. So that means there are some real practical considerations. We're not going to know until near the end of the year what kind of realized gains and losses we're going to have in the client's non-qualified portfolio. We're going to have oftentimes some unexpected incomes. Maybe there's inheritance. Maybe the client had an emergency. They took out a withdrawal and they told you about it at the end of the year. Maybe there was an unforeseen expense in the middle of the year and there was no choice but to pull a little extra money out of an IRA. And we're not even going to get phantom capital gains estimates, pass-through capital gains for mutual funds until the end of the year. So there are a variety of things that we really can't narrow down, and we probably don't want to execute on these Roth conversions until late in the year. So how do we do this in practice? In reality, we're going to drill down into the current year with more depth than our financial planning software is generally going to let us do. And that regardless of which financial planning software you use, whether it's Income Insight or eMoney or Money Guide Pro, Right Capital, whatever it is, they're all going to be wrong because they're all going to have to project realized gains. And you're never going to know until you're actually in a year what that really looks like. So when we drill down into the current year, all we have to do from that Income Insight screen is click on the cash flow button, and it's going to bring up all the detail you would need to run a tax clarity estimate. So it brings up all the detail and we can inspect it. No black box here. And all we have to do is click this button at the bottom that says add tax map to tax clarity. We name it. We name the scenario. So I've named this 2021 conversions because we're in 2021 and I want to drill down and get to reality for this year. Now we've got a tax map that we can actually manipulate. And so we see the same 96,854. The map is a little larger because we're really focused now on this one scenario. I click the input data tab, and maybe the client had some part-time income. So maybe we need to update that. That might not have been included in the plan when we first did the plan. Maybe they ended up doing consulting work. Capital gains is the biggest area. So in our practice, we always run a realized gain loss report, and we also do some estimates for what the pass-through gains are going to be for any mutual fund holdings that clients have in their account. And we always update this before we do any of these Roth conversions. So in this case, let's change the long-term gains. Let's say that we actually recognize 30K of long-term gains this year. If we did that, we're going to get a very different tax map than what the software might have projected. So we just click see results, and now we've got, wow, it's a really different map. We're sitting in a 27% effective marginal rate. And that's because each dollar of IRA that we withdraw pushes an extra creates an extra 15% tax on a capital gain that could have otherwise come through in a 0% bracket. So that gets really interesting. Instead of converting up to this point, which is what what kind of the broad financial planning software, the lifetime strategy software would have told us, we're going to now get narrow, and we're going to say, we don't want to be there. We paid a bunch at 27. We want to avoid that. How do we do it? We want to be here. And all I got to do is hover over that, and it's going to tell me my total ordinary income that I can have on the return before jumping into that 27. So in this case, it's 70,750. It's about 26 grand less. So all I got to do is go back and update my scenario, or I can create a new one. I can say default conversions, and I might say 2021 final conversions. That's a pretty common way advisors do that. And then I'll update this. Rather than $86,000 here, I drop it down to 60, see results, and I get my new map. If I'm going to document for the client file, this is what I'm putting in the client file. And that's ultimately how we narrow down, we change those things for what has actually happened in that year. So we try to squish all our clients that we have this kind of work that we're going to do for them October, November, and early December. Because that's when we're going to be able to get those really good estimates. That's the service calendar considerations. There's no recharacterizations for conversion, so it's really important to get it right. Generally, you're going to want to finalize Roth conversions in Q4, November or December if possible. Maybe you do the planning work, the early planning work early on, but then make sure you update it in the fall, in the late fall. Beware of the custodial timelines. For example, we custody at Fidelity. I think the last few years, it's been about the second week of December when we could guarantee that we could get these done before the end of the year. And then finally, if you have clients who still have some some earned income, remember they can contribute to IRAs. So that's one nice thing that did recently change is there's no maximum age for the IRA contribution. So if they do have some earned income, we can sometimes do some cleanup in the spring if they have earned income. Maybe we converted a little too much. Sometimes those IRA contributions can help clean that up. So we covered a lot in half an hour. This was really the practical walkthrough of how do you use Income Insight and Tax Clarity. It's really starting with the overall strategy, quantifying the value, then getting narrow on the current year to say what actually happened, doing that towards the end of the year so that all the things that are likely to have happened in the year have probably already happened. Nail down that conversion amount for that year and get it done. So that's the way to identify the lifetime value of it and actually execute on a year-by-year basis. Now, the last thing is obviously talking about it. How do we go out and communicate that this is a value that we can deliver to our potential customers, to our potential clients? There are a variety of tools. So every single one of our software tools includes a marketing kit, which includes social graphics and videos. It includes email templates. It includes the same PowerPoint presentations that we've been using for the better part of a decade here in the library system in Omaha. It's how we've grown our own practice. We've got lots and lots. I say thousands. I have no idea exactly how many advisors are using these on a regular basis, but it's a good number across the country. And so equipping you to communicate this value, to grow your business, equipping your clients to refer the services that you're able to provide for them is really the value here. That's the second additional big value. So that said, I think we've got one more last poll question. It's just, would you like to talk one-on-one? If the concepts that were here today were appealing to you, you can certainly go out and take a free trial of the software. You can poke around in there. You can do everything we just did. You will get a recording of this PowerPoint, this presentation. and you'll have the ability to, do that right through a free trial. It's a full functioning free trial. So with that, I know I've seen quite a few questions come in through the course of the presentation, Lauren. You want to pop into some Q&A?
Absolutely. We have had a lot of great questions come in. So we're going to tackle as many as we can. And if we don't get to your question today, I will make sure that we send you an email before the end of the week. So this question came in a couple of times. I would love it if Tax Clarity would do conversions in higher brackets. Is it currently limited to the 12%?
So anytime you're thinking about harvesting patterns, we're talking income insight, right? Because that's over a lifetime. Tax Clarity, you can calculate conversions in any bracket. Income insight over a lifetime currently only lists up to the 22. It's definitely a situation where we'll be identifying some higher values and adding those strategies in the future. It's just an uncertain timeline when they get added to the software. In the meantime, though, I suppose I should say that you can do any of those conversions inside Tax Clarity, just in the single year.
I understand that most opportunities for Roth conversions come during the otherwise low tax years between peak salary years and the onset of RMDs. What about the increasing number of clients who are already in retirement, maybe already receiving RMDs and have significant tax deferred accounts? Does the software provide simple analysis?
Yeah, conceptually, we have clients who are over 70, 73, 74, 75, that don't have huge RMDs. The problem is if they already have really high RMDs, and they don't need them for living expenses, then each marginal dollar that we might convert really probably isn't going to experience any additional value, right? Because we're going to be paying a really high cost to convert that dollar. So even when you account for increased Medicare premiums, et cetera, we often don't see that being a high value conversion situation. And that's actually something that's pointed out in that paper that I referenced early in the presentation.
How does your software evaluate next generation taxes on inherited IRAs?
So that was the beneficiary tax rate assumption at the very beginning. You can set that assumption at whatever is reasonable for your particular client case.
What rate of
treat only the taxable assets that way, and of course, things that get a step up in basis will get a step up in basis, et cetera.
What rate of return is Tax Clarity assuming for growth on the qualified accounts? Conservative, moderate, aggressive, doesn't specify much.
So on all the accounts, it's a 60-40 portfolio. And actually, I'm going to send out, there'll be a follow-up email that everyone will get that will have a sample report that includes just that conversion strategy, not Social Security, just the conversion strategy. The appendix has all the rates of return. Long story short, on the equities, I believe it's 5%. For capital appreciation, 2% for qualified dividends, and on the bond side, it's negative 0.5% for capital gains and 3.4, I believe, for a net return of 2.9, 3.4 ordinary income per year. So round numbers, roughly 5%.
How would you implement the software if a client selects an annuity as a retirement vehicle versus an IRA?
Actually, inside the software, you have the ability to enter annuities separately. In the situation where there is only an annuity and there are no other accounts, software isn't going to be able to do that. It can take withdrawals. It'll have you put in, what's the free partial withdrawal corridor, how long does it last, how long do surrender charges last, et cetera. And then it'll do what it can without violating that free partial withdrawal. But most of the time, those are not good conversion situations.
Are you assuming a max conversion, taxes being paid from a non-qualified account? I think that was earlier on.
We are. So that's a current assumption in the software, is that we need taxes to be paid from a non-qualified account.
A couple of people asked if the software feeds into Money Guide Pro eMoney.
It does not. It's advisors who are really using this as the core of their practice are using it as their financial planning software. Their practices are focused on retirement income people.
If you go past the peaks and then into the valley on the tax map, does that work for all previous dollars, or does each dollar get taxed according to the tax map?
Each dollar gets taxed according to the tax map. So for example, if I'm in the middle of a spike, I'm going to have, if I want to go right, if I want to harvest more, I'm going to pay more of that spike. But then if I get past it, sometimes getting past it offsets, the trouble of having to pay the spike that year by virtue of avoiding it in future years.
How much are subscriptions, and what kind of post-sale support and best practices are provided?
Sure. Tax Clarity is $80 a month. Income Insight is $120 a month. It includes the marketing tools. It also includes an actual support team that picks up the phone, and when you have a question, they will walk you through it. That's one thing that we pride ourselves upon, and they've been doing it for years. So please do pick up the phone, which, as I understand, is in pretty stark contrast to most of the tools out there.
Great. Well, I know we're already over our time. I know there's a few other questions that are still rolling in. Like I said, I'll make sure that when I send out the recording, I'm also getting an answer to all of your questions, and I'll send those personally via email. I want to thank you so much for joining us today. Thank you, Joe, for taking the time. And